The unsettled calm. When markets whisper what bonds already know, you observe the surface, don't you? A momentary calm descends upon the volatile currents of global markets, a deceptive stillness after the initial shock. Yet, beneath this fragile recovery, the bond market, the very memory of our economic system, signals a deeper unease, revealing the true cost of our collective illusions and the relentless pursuit of fleeting stability. You see the surface calm, don't you? The market's breath seems even, a momentary reprieve after the sudden jolt of geopolitical tension. Bitcoin, that digital echo of our collective will, finds its footing above 70,000, and the great indices of equity markets seem to mirror its ascent, pulling back from the brink of a deeper fall. We watch these numbers, these flickering symbols of value, and a quiet relief washes over us, a collective sigh that the storm has passed. Or is this merely the eye of a different kind of tempest, one that has been gathering strength in the shadows of our economic choices for far too long? We are told of stabilization, of a recovery from an early weak slide, a reaction to the sudden surge in oil prices, itself a direct consequence of renewed military friction in critical global arteries. The narrative is simple. Conflict erupts, fear spreads, assets deemed risky are shed, then calm returns and the market corrects. It is a story we have heard many times, a predictable rhythm of human reaction to the unexpected. But what if this calm is merely the pause before a deeper revelation? What if the true story is not in the rebound, but in the persistent, unwavering signal emanating from the very bedrock of our financial architecture, the bond market? The initial tremor, you remember it, don't you? Oil prices, those liquid veins of global commerce, surged as the Strait of Hormuz, a narrow passage through which a fifth of the world's oil flows, became a focal point of geopolitical anxiety. Fear, that primal architect of market movements, dictated the immediate response. Assets were liquidated, positions unwound, and the collective pursuit of safety drove prices down. Yet, the swift assurances, the promise of naval escorts, the political risk insurance, these were the immediate balms, the temporary salves applied to a wound that runs far deeper than a single choke point. They calmed the immediate panic, yes, but they did not address the underlying fever. For while Bitcoin and equities found their equilibrium, the bond market continued its relentless upward climb in yields. The yield on the 10-year U.S. Treasury note, that benchmark of long-term economic expectation, has been rising not for a day, but for consecutive days. And the 2-year yield, far more sensitive to the immediate whispers of monetary policy, has followed suit, jumping with an almost urgent insistence. What does this tell us? It tells us that the market, in its deepest, most fundamental layers, is not convinced by the surface calm. It is reading a different script, one written in the language of time preference and the true cost of capital. You see, bond prices move inversely to yields. When yields rise, it means the market is demanding a higher return for lending its capital. It is a signal, clear and unambiguous, that the perceived risk of future inflation has increased, or that the expectation of future economic growth, and thus higher interest rates, has solidified. In essence, the bond market is telling us that the future cost of money is not going down as quickly as some might hope, and perhaps it is even going up. This is the market's memory speaking, its quiet wisdom contrasting sharply with the often frenzied present. This persistent rise in yields reveals a profound tension. On one side, we have the central planners, the architects of our fiat system, who have for so long attempted to dictate the price of money, to manage the very flow of time preference. On the other, we have the spontaneous order of the market, the collective action of countless individuals, each making their own choices about present consumption versus future savings. The bond market, in its current posture, is a testament to the limits of central planning. It is a quiet rebellion against the illusion of control, a declaration that reality, in the end, always asserts itself. The implications are stark. Traders, those tireless interpreters of economic signals, are reassessing the outlook for monetary policy. The conflict-driven spike in energy prices, even if temporarily contained, threatens to rekindle inflationary pressures that were already proving stubbornly persistent. The narrative of imminent rate cuts, once a comforting lullaby for risk assets, is now being rewritten. Investors, through their actions in the bond market, are signaling that the probability of significant rate reductions this year has diminished. The central bank, caught between the rock of inflation and the hard place of economic fragility, finds its options narrowing. Consider the words of those who observe these currents closely. A trader from a leading digital asset market maker notes the tension, the conflict between a resilient economy and an inflationary energy shock. This, they suggest, is precisely the kind of setup that keeps the central bank frozen for longer. What does frozen mean in this context? It means an inability to act decisively, a paralysis born of conflicting signals and the fear of exacerbating an already precarious situation. It is the consequence of years of intervention, of distorting the natural price signals of the market, and this is where the true nature of our economic system is laid bare. The central bank, in its attempt to manage the economy, often finds itself reacting to symptoms rather than addressing root causes. When inflation rears its head, it is often a consequence of prior credit expansion, of an abundance of money chasing a finite supply of goods and services. An energy shock merely acts as an accelerant, revealing the underlying fragility, the monetary illusion that has been allowed to fester. Some observers, those who understand the slow, insidious creep of economic forces, remind us that the inflationary impact of oil shocks rarely unfolds in a single dramatic moment. It is a gradual process, a ripple effect that spreads across the global economy, slowly, inexorably. Oil prices, they note, often climb steadily for weeks after a major geopolitical event, the true physical disruptions only manifesting later in supply chains and inventory levels. Markets, in their initial reaction, often underprice this first phase of supply risk. The real move, the true reckoning, tends to happen once the physical realities begin to bite. This slow burn, this gradual unfolding of consequences, is a testament to the dispersed nature of knowledge. No single entity, no central planner, can fully grasp the myriad interconnections and feedback loops within a complex global economy. The market, through the collective actions of billions, slowly, painfully processes this information, adjusting prices, reallocating resources, and ultimately revealing the truth. Adding to this complex tapestry are the recent strong economic data points emerging from the U.S. services sector. Activity continues to expand, and private payrolls show robust job creation. On the surface, these appear as signs of strength, of a vibrant economy. But in the context of rising yields and persistent inflation concerns, they become a double-edged sword. Strong economic data, when coupled with inflationary pressures, gives the central bank less room to maneuver, less justification for rate cuts. It reinforces the market's belief that rates will remain higher for longer, further pressuring risk assets. You see the paradox, don't you? What appears as strength in one dimension becomes a constraint in another. This is the essence of economic calculation under a fiat system. The signals are distorted, the incentives are misaligned, and the true health of the economy becomes obscured by the very metrics designed to measure it. Is it true growth, or is it merely the lingering effect of past monetary expansion, a temporary surge fueled by an unsustainable credit cycle? All eyes now turn to the upcoming non-farm payrolls report and wage growth figures. These are not just numbers. They are reflections of human action, of the choices individuals make in the labor market, of the value they place on their time and effort. A hotter than expected print, a stronger signal of economic activity and wage inflation, could further weaken the already dwindling expectations for central bank rate cuts. It could inject fresh volatility into financial markets, not because the economy is necessarily failing, but because the illusion of cheap money is being further eroded. This is the relentless logic of the market, the praxeological truth that human action, driven by purpose and preference, always seeks to assert itself against artificial constraints. When the price of money is manipulated, when credit is expanded beyond the limits of real savings, distortions inevitably arise. These distortions manifest as booms and busts, as periods of monetary illusion, followed by painful reckoning. The bond market, in its current state, is simply signaling that a reckoning is underway, that the true cost of capital is reasserting itself. And where does Bitcoin stand in this unfolding drama? It is not merely another risk asset to be bought and sold in the same breath as equity. Bitcoin is the antithesis of this system. It is sound money, a digital scarcity born of mathematical truth, immune to the whims of central planners and the distortions of credit expansion. It is a store of value that cannot be debased, a form of collateral that cannot be inflated away. In a world where the memory of the bond market is signaling caution, Bitcoin offers a different kind of memory, an immutable ledger of truth, a sanctuary from the monetary illusion. It is the ultimate expression of individual sovereignty, a decentralization of knowledge and power that stands in stark contrast to the centralized attempts to control our economic destiny. As the traditional financial system grapples with the consequences of its own design, Bitcoin offers an alternative path, a return to real savings, to a lower time preference, to an economic order built on voluntary coordination rather than coercion. The question then is not merely whether markets will stabilize or if rates will be cut. The deeper question, the one that lingers in the quiet spaces between the numbers, is what kind of economic reality we are truly building. Are we content to live within the cycles of illusion and intervention, or do we seek a foundation built on immutable truth? We are block-sonic. We don't predict the market. We read its memory. Never forget, Bitcoin is only yours in your cold wallet.